Nick Curry,
Here.
Dan Jansen,
Here.
Christine Hoffman,
Here.
Brandon Maresma,
Here.
Eddie Bergara,
Here.
David Cohill, John Patridge,
Here.
Matt Brokey,
Here.
John Gottstilla,
Here.
Jason Sharp,
Here.
George Handler, Ed Dawson, John McDaniel, Lance Hewish,
Here.
Debbie White.
Here.
Okay, first order approval of minutes for the May 29th, 2024 meeting. This is just a voice vote, so all in favor of approval?
We should still probably do a motion. Don't do a motion, we'll second.
All right, so somebody give a motion.
So moved. Second.
All right, all in favor?
Aye.
Any opposed? Okay. Get approved of this.
I know, it's been a while.
Yeah. Brendan, here to give us, talk about Mariner Institutional.
Good afternoon. Happy to talk about the firm, but I think we've covered that previously, unless you'd like me to go into it. But good afternoon, everyone. Again, Brendan Bavrica of Mariner Institutional for the newer folks. I'm an investment consultant on the plan. So we're not specifically managing any of the money, but we're coming in, giving you an aggregated report, letting you know how the entire plan did and each of the individual subcomponents. And then also we'll periodically, assist with asset allocations, manager recommendations, things along those lines. And interestingly, we actually do have a manager recommendation for you that we'll get to in a little bit. But if it's all right, we'll kind of go through the typical kind of quarterly materials first and get to some of those items a little bit later, if that's all right. So you've got hard copies in front of you. What you'll notice, the report or the slideshow that I have up in front, all the materials are in front of you, but I don't have every single page. Like the 70-page book, I've just distilled it down to the 15 or 16 pages that we're actually going to look at, but I kept all the page numbers, so if you want to follow along, it won't be necessarily quite in the same order. But just really quickly, so the kind of the first page of the presentation is page number page number 4 of the book. And what I'm highlighting here in the upper right-hand corner, the quarter ended June 30th was positive, very positive, at least it relates to the S&P 500. S&P was up over 4%. Let's notice though, if you look on the mid cap and the small cap, the Russell 2000, those were both down 3.3% within the quarter. So you had a big deviation between large cap and small cap within the quarter, and then that continued on. If you look in the bottom right, for the last 12 months, the S&P was up almost 25%, while those small and mid cap stocks were up 10 and 12% respectively. So a big difference between large and mid cap. If you kind of flip to the next page, tucked in your hard copy, you actually have 2 loose leaf handouts. And I want to spend a little bit more time kind of talking about the S&P or actually more specifically the Russell 1000 growth. So this first chart in front of you, I'm sure someone has mentioned the Magnificent Seven. I probably did it last quarter. But that's what this particular chart is looking at for the first 6 months of 2024. A couple of years ago, it was a slightly larger group. We were calling them the FANG stocks. And then a couple of them sort of fell out of favor, so we dropped the FANG and we started calling them the Magnificent Seven. You can see those companies, it's Google, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. Those are the largest weights within the Russell 1000 growth, as well as the S&P 500. This chart looks specifically at the Russell 1000 growth. So what we've got here on this chart, the blue line represents the average gain of those 7 companies for the first 6 months of the year, 32.25%. The index returned 20.7. In the Russell 1000 growth, there are 440 stocks. So if you take out those top 7, strip those out for a moment, the other 433 stocks only earned 10.3%. Less than half of the index return. So when I go back to a page before in the book when we're talking about the S&P 500 or the Russell 1000 growth being positive, But what we're really saying is about 4 stocks were positive, really, really positive, and the rest really kind of struggled. So there was a lack of participation within the markets, at least through June 30th. Okay? So that will be somewhat telling when we get to some of the performance later on in the report.
Well, isn't NVIDIA kind of an anomaly with they been through most recently?
I mean, yes, it certainly is a little bit unusual. Now, things like that do happen from time to time, where one company gets an incredible amount of momentum and pressure, if you will, and ride it. Think that this is the future, and it goes up by 2, 3, 4, 500%. That does happen every once in a while, but it tends not to be a long-term
Right.
pattern.
That's my point.
Yeah. So if you flip to the next loose leaf page, what this does takes an additional look at the Russell 1000 indices. So again, I mentioned the FANG stocks. That's what we were kind of referring to that group as a few years ago. It's morphed into the Magnificent Seven. What this graph does is look at the top 10 holdings of the different Russell 1000 indices over the last 10 and a half years. And so when you look on the left-hand side, back in 2013, the Russell 1000 value, the top 10 largest companies represented about 27% of that index. The growth, the top 10 represented about 22% of that index. The typical, the long-term average, if you will, somewhere in the low to mid-20s for the representation of that top 10. With this run that we've been on, in particular in growth, and more specifically in the FANG, which turned into the Mag 7, you'll notice that orange line continue to move up and to the right. So we finished June 30th with those top 10 now exceeding 57% of the index. The previous high for the growth index was back in the dot-com bubble, late 90s, early 2000s. It reached about 40%. That was the record concentration back at that time. Then it spent the next 7 years going back to the low 20s, sort of unwinding itself. I mentioned that to say, a few years ago we hit 40% past it, and obviously just kept going. So now we're above 57. Today we're higher than that in terms of the concentration. So I just want to sort of demonstrate that it's been a very narrow market, and the S&P and the Russell 1000 growth are becoming increasingly concentrated in those super large names. Now, if they continue to do well for the foreseeable future, no problem, everything will be fine. But if we kind of normalize those weightings for whatever reason, whether the market takes those down or they stop growing and everything else comes up, you're likely to see a scenario where the benchmark struggles because it's so heavily weighted in those few stocks that they don't continue to do well. Just a little bit of an interesting dynamic that's been playing out over the last few years. Any questions on that? No? All right. So I'll move ahead. Sorry, there was a second page to that handout if you just were curious about the individual companies and their weightings. But I guess the only thing I'll point out is that the top 3 holdings, each over 10%, represent a third of the large cap revenue market, just 3 companies, NVIDIA, Microsoft, and Apple. So let's get back to the actual regular quarterly book then. I'm now on page number 11. Down in the bottom right-hand corner, one of the things we talked about over the last, really a couple of years are interest rates and how those have been changing. For a good while, we were talking about interest rates moving higher. And we actually did see within the quarter, even though the Fed has not been raising rates, interest rates did actually move up within the quarter. The gray line represents the blue line represents where we were at the end of the quarter, which is a little bit higher than the yellow line, which is where we were 3 months ago. Interestingly, if you took this picture as of today, we would have actually fallen down the page. Interest rates have come down in the current quarter, but through the period June 30th, we did see interest rates ticking higher. Now I'm going to jump to page number 14 and start to get into the plan-specific information. So we always review this page 14 because it tracks the long-term history of your plan. And just as a reminder, the gray or blue bars down at the bottom represent your net cash flow. So back in 1987, you had $11.8 million in the fund. And if you look at those gray bars along the bottom, they actually do increase a little bit in the first 10 years or so. And then in roughly 1990, or 1996, 1997, somewhere in there, they start to decline. Meaning, you're paying out more in benefits than you're taking in contributions. And now, if you fast forward all the way to June 30th, 24, you've taken out all of that $11.8 million plus an additional $38.8 million, or collectively about $50 million. Yet you've grown the asset from that $11.8 million up to $120.4 million. And that, in a nutshell, that's the sweet spot of pension investing. You build up the nest egg to the point where it grows at a faster rate than you're paying out that what we call negative cash flow. Right? The growth of the money continues to pay all of those growing levels of payments, which is, and if you take this out another 20, 30, 40 years, you're likely to see instead of negative 38, it's going to be negative 100 million. And hopefully at that point your assets are 300, 400 million. They should continue to kind of separate from one another. The other line that we show here is the theoretical, a feeless index that is set at the assumed rate of return. So if you had been able to just earn the assumed rate of return each and every year, you'd be at $106 million. So by investing actively in the portfolio and doing all of the different diversification methods and everything that the plan has, you have an excess of about $14 million on top of what that assumed rate of return would have provided. Next few pages kind of slice and dice the asset allocation. I like page number 17 because it shows the deviation from our target, our investment policy. And what you'll notice is we're generally pretty close, over by about 2% in domestic equity, slightly over in international, and then a little bit under in both domestic as well as global fixed income. We did take some action last time to rebalance out of equity. Those differences were a little greater 3 months ago, so we did take some action to bring those back in line. And generally speaking, we're pretty close to those target weights, although I do have a little bit of an update for you a little bit later, where we're actually deviating a little more from what you're seeing here due to recent performance. So the next page is page number 21 of the report that I'll kind of spend time on. So although the market environment and the plan performance was positive, we earned 84 basis points versus the benchmark of 1.66. We were behind and placed in the 63rd percentile among the peer group. We'll kind of get to some of that underperformance in a second. Most important number on the page, that second column in the FYTD, the fiscal year to date. Again, we operate on a October 1 to September 30th fiscal year. So this report represents our 9-month number. 16.1%, just slightly behind the benchmark of 16.45, but placing in the 27th percentile. Or for the last 9 months, you've outperformed 73% of public funds around the country. Okay. Overall, still a very good result. If you take it out over 5 years, 7.3%, slightly behind that 7.9, and placing right in the middle, 52nd percentile. As we move down the page and we start to look at the individual components, we have the Vanguard Total Stock, our index fund, did exactly what it's supposed to, replicating the index. And notice that fiscal year-to-date return, 27.4%. Really phenomenal for 9 months. Allspring, nice return, 5.3%, but that was behind the policy of 8.3, one of the reasons for the deficit at the total fund level. But for the fiscal year, 39 versus 37.8. So they've done nicely over the last 9 months in total. But you will notice some underperformance over the longer term. We've talked about them multiple times. They were in 6 months ago, maybe 9 months ago, they came in and did an update presentation for us, so you've heard from them. But I also have some additional information or material to talk about as it relates to them, because some other changes in addition to just the performance. We also have JP Morgan Equity Income outperformed. They were down 1.8, but their benchmark was down 2.2. And then Eaton Vance, our small cap manager, again, was down 3%, but their benchmark was slightly outperformed, but it certainly was negative in terms of the quarter. And you can really see that disparity between the Vanguard total stock and the Allspring portfolios. The core and growth is where we saw positive results. Value and small cap is where we were seeing the negative results on an absolute basis. The next page gets into our international equity, and this is where we also had some further underperformance. Each manager actually did a little bit worse. DFA was down 0.5% versus 96 basis points. Euro Pacific was down 23 versus a positive 1.17, and then the WCM Focus was down 1.4 versus a positive 1.17. Although on a fiscal year-to-date basis, certainly a number of those returns are better, but not quite keeping pace with the U.S. large cap market. And then we've got our fixed income portfolios. We've got the Baird short term, which was up 107 for the quarter versus 95. And then the Sawgrass portfolio, 17 basis points versus 15, essentially in line. But what you see there is the impact of that increase in interest rates that we saw within the quarter. They did have a positive return, but it was impacted by that rise in interest rates. And as a reminder, we did allocate some money. We took some money out of equity last time and put it into the fixed income portfolio of the Sawgrass. So kind of in this quarter, in that short period, that did hurt a little bit, but you will see, I'll kind of update you through July, we're starting to see some much better returns out of fixed income. As you move down to the bottom of 22, we do have the PIMCO diversified income, our non-US exposure. They did very nicely. They were up 55 basis points versus a negative 1%. And then the last piece, the JP Morgan real estate portfolio was up 1.3 versus a negative 64 basis points. So relatively speaking, they did very well, although you'll notice for the 12 months, they are behind more, down 14%, versus 9.6. As a sort of a general commentary, it seems like this quarter, or perhaps next, is looking like it's kind of the bottom of the real estate cycle, barring any other kind of big shocks. Looks like we're going to be getting an interest rate cut next month. 25, 50 basis points, we'll see, but that should help a little bit in terms of the real estate portfolios. But even without that, they're kind of, the rate of decline has been slowing. JP Morgan obviously did well, even ahead, but the group of those managers, a lot of numbers closer to zero, flat, so kind of expecting the next quarter or two to start to see a resumption of positive returns on real estate. Let me pause there, see if there's any questions, comments, anything that I skipped over that you'd like me to expand on? No. Okay. Well, now this is not in the presentation because it's all kind of up to date, but we did actually just this morning. I don't know if you get a chance to send it out yet. Probably not. I did. So in your inbox, if you haven't already seen it, we did put together the July flash report, and just high level for the month of July, we were up 2.1%, slightly ahead of the policy, which was up 2%, which brought our fiscal year-to-date return to 18.4%. So obviously fantastic. I also ran the plan assets as of today, and we're up an additional 1.6 million on top of the July returns, which equates to roughly 1.4%. So if you add the 1.4 on top of the 18.4, you get to somewhere in that 19.7, 19.8 or so as of today on the fiscal year to date, with call it 5 weeks to go in the year. So a lot of absolute good performance in the June 30th report in terms of our assumed grade, but it's gotten even better since then. With that, we did have about I mentioned back in the June 30th report, we were overweight to equity by about 2.2%. Now, as of today, we're actually over by 2.8% and a little bit more international. So still well within the normal ranges, but we have increased that equity exposure because of that performance that has happened. I also was referencing Sawgrass, just to give you an idea. Just for the month of July, the Sawgrass portfolio was up 2.5%. So kind of outpacing the overall portfolio, equity portfolio.
Does that change your target?
No.
Okay.
I mean, it didn't. It's not enough to be significant. Total fixed income is sitting at the overweight's on the equity side, we were underweight. So it, you know, instead of being 2.2%, it might be 2.1% underweight, but it didn't take us from an under to an over. So one thing that I just wanted to, we are well within the normal ranges of the investment policy, not even, you know, approaching the maximum. But we are sitting here after a 11-month period of the fiscal year where some of those equity portfolios are up 30, 29 type %. We already took some of those chips off the table last time and rebalanced. Now, even closer to the end of the fiscal year, we are overweight to equity by approximately $4 million. That's kind of what it works out to be in today's dollars. So I wanted to float the idea of maybe taking a few more of those kind of chips off the table, if you will, a little bit more of that overweight. Also, with the prospect of interest rates coming down, it seems like there could be continued favorable performance out of fixed income as well. So I wanted to mention that as a possible rebalance.
And you're going towards fixed.
And or cash. We've kind of been doing that, periodically. Again, most of the time we've been doing this, we've been 5-6% overweight. We're only sitting at 3%, 3.2% in total. Like it's a smaller overweight. So there's not really the need to do it, other than again just looking at an equity portfolio that's up 30+% and just considering maybe taking a few of those dollars off.
Although if you want to do that because we're worried that we're going to have continued growth in that and we'll be outside the boundaries, I just assume take that growth and then shift it into fixed. Leaving the chips on the table, not these gambling metaphors when we're talking about
Right.
investment. Drive you nuts. That's not what we're supposed to be doing. But so yeah, if there's every reason to believe that things are going to continue going as they have been, leave them on the table, then we'll adjust afterwards.
I agree.
I'm very comfortable with leaving it where it is.
There, then we look at it next quarter.
Okay.
So we're at.
Do you have any, sorry, I didn't ask you this in a pre-meeting a few weeks ago, I think, but approaching an election, is there any statistics on volatility and anything that could provide any guidance?
I didn't bring anything. We have a chart, and I'm happy to send this out after the meeting, that kind of looks at all the different scenarios. Incumbent wins, but the Congress changes hands, or the incumbent in the White House loses, and Congress stays or changes hands, all those different scenarios. 12 months later, essentially, if you average them, all the different iterations, they're positive. But some are more positive than others. Typically, when the incumbent wins and there's a change, that tends to be more positive than when there is a change in terms of the incumbent parties. But I can certainly send that along if you'd like to see it. You mentioned volatility. It won't be volatile. I'm fairly certain of that. Especially until the market thinks it's identified who's going to win. That's fairly typical of the election year cycle. You have a lot of choppiness until the market thinks it's identified who's going to win. Sometimes that isn't until early November. Other times it's earlier on. But if and when that happens, if there's a change, if it's perceived that the incumbent party is going to lose and the challenger, if you will, is going to win, then maybe different. You start to see a rotation. In this case, if it's a Democrat that loses in favor of Republican, maybe defense industries and a few things like that will tend to do a little better, as opposed to healthcare, maybe some of the other sectors. But it doesn't necessarily prevent just a sell-off or anything like that.
It's been a long time since we've had somebody like Donald Trump. Well, actually, it hasn't been a long time, it's been a year. But, he's not normal in terms of Democrat versus Republican. So everything's up in the air.
In the short run, there's going to be, again, I use the word volatility. I would expect a lot of volatility. But, 2 years from now, 5 years from now, the driver is going to be economic growth. That's really what the market performance will be measured on long term. Market sentiment based on who's going to win, not going to win, it'll make the roller coaster go up and down. The the real question is, we've got obviously inflation cooling, the Fed talking about needing to cut rates here pretty soon, and negotiating the term that's out there is the soft landing, right? Can we temper inflation, get that down to normal without causing a recession? If that happens and the market can kind of stabilize and then continue to move higher, then it's positive. If the Fed overshoots things with the higher rates and they cause us to go into recession, then obviously that's gonna be the bigger impact in terms of securities prices and whatever, 2 years from now, 3 years from now, less so kind of who wins.
I was in a meeting this morning and the same discussion came up, and similar to what you're saying, that's not necessarily, because no one's projecting any austerity measures or plans, so that it's not really gonna impact the market per se, but there will be a lot of rockiness. But they did talk about the misery index, is that what it's called?
There is, yes, there is.
And that's a combination of inflation and, and what, unemployment. So that's more of a predictor of how the election will go based on that.
Right.
So that is a real thing.
It is a real thing. I don't know what it's forecasting or what it's suggesting right
Right.
now.
Both unemployment and interest rate, inflation are relatively low historically, so.
Yeah. So according to that, if it's just that simple, then it's fairly, it's a strong level currently.
Right. I'm teaching a stats class now, and when you've got data from here to there, it's pretty logical to kind of project it out. But if something dramatic changes here, then all that is just out the window.
Right.
We're just in a new reality, not unlike the coronavirus. The markets didn't see that coming, and so similarly, massive tariff increases, or who knows what could happen.
China, Taiwan,
China,
there's any
Taiwan,
number of
yeah.
geopolitical type things that can certainly throw a wrench into the entire thing. But absent one of those kind of shocks to the system, again, I think the primary driver is ultimately just going to be economic growth and activity. And really what we're looking at is generally continued strong corporate earnings, resilient consumers in spite of, elevated interest rates and all of these things. But with the prospect of things cooling down, inflation coming down, will that bottom out and kind of stabilize, or will it, turn into a much slower situation, ultimately a recession? But again, as of right now, most of those indicators kind of show soft landing and positive, which is partly why the market has been so strong in the last 6 weeks. Because more of that data has kind of been showing that sort of softer landing scenario as opposed to recession. Any other questions on any of the quarterly materials, update materials? Okay. Then the other item that we have for you is in the separate handout book. So we talked about Allspring a few minutes ago. They were in, again, not too long ago. In late May, they made an announcement that one of the longtime portfolio managers, Tom Ogden, is retiring. Effective sometime in July. Which by itself is not a surprise. He's been part of the team for a long time. And I should also mention that, due to performance, we have been kind of scrutinizing the portfolio already, our research team, looking at them, having extra calls, things like that. But as a part of his retirement announcement, what Allspring did is they took what we call the dynamic team, which is the portfolio and what Tom was overseeing, along with a group of people, and another separate large cap growth team, and they decided to combine them. And a couple of the analysts from the dynamic team were kind of, essentially replaced or removed from the team, as were a couple of analysts from the other side. But the two teams have had fairly dissimilar portfolios. Some overlap because they're both in growth, but only about half of the portfolio or so is similar. And so with sort of the performance concerns that we've been tracking, and now some sort of the prospect for some portfolio changes because of the different philosophies with these teams and not knowing how that was really going to play out, our research team has made the recommendation to move on from the Allspring strategy. And so this material in front of you is to begin the conversation to consider alternatives to that Allspring large cap growth portfolio. Before I go further, I did want to mention that Allspring is offering a fee holiday, essentially waiving their management fees at least through the end of the year for anybody that does stay on. They're trying to, I don't want to
Of course, they are.
paraphrase for them, but they're trying to buy some time and get people to be comfortable. And of course, they've offered to come in and talk if you'd like to hear from them and so on. But I just wanted to make sure that you were aware of that information.
You must have been some guy. Stir all this up.
So with that, let's go ahead, I'll just kind of be real brief in the book. So I've got 4 names that we're kind of putting forth to consider as replacement ideas. It's not on this page, but just for your information, you're paying Allspring 66 basis points or 0.66% to manage the current portfolio. So what you'll see is, with the exception of Alger, the other names are cheaper. And one additional little piece, Winslow, the Winslow large cap growth, they actually offer a separate type of vehicle called a CIT that is actually even cheaper than what is shown here at 60 basis points. So that's a separate account, but they offer a CIT, which could be for as little as 35 basis points. So that is a
What is the CIP?
collective investment trust. Think of it operates like a mutual fund. The only difference, it is a contracted vehicle. So you have a contract for it as opposed to a mutual fund, which you don't. You don't sign a contract, but it operates in the same way. The one thing that's actually slightly unique is this CIT can actually be purchased at your custodian, Salem Trust. Some CITs, you actually, the money leaves your custodian and you're buying into the investment at where the CIT is custodian. But this is a CIT that actually can be held at your custodian.
Is there contractual amount, since you're signing a contract, is there a amount of time that you're contracting to?
So what's the contract for?
Just the provisions of the actual CIT.
How does it differ from a normal mutual fund?
Mutual fund under the Securities Act of 1940, the prospectus is essentially the agreement and you can't modify it. But a CIT, you have the ability to adjust some features. So just to give you an idea, in Florida, there are usually, the attorneys in Florida will want certain provisions about public records and things like that added to the agreement that wouldn't be in place in the fund documents. A mutual fund can't modify the prospectus for an individual client, but a CIT, they can have what's known as a side letter. They won't actually change their document, but they'll sign a side letter that can work on some of those provisions that aren't actually in the main document.
So there's nothing in that difference that really has an impact on the likely return and all that?
No,
Or
no.
as Brandon jumped on immediately, that it might be harder to pull, it's not gonna be harder to pull money out of it and move it around.
Correct. It doesn't affect the portfolio, it doesn't affect the returns, anything like that. It just sort of gets into some of the legal items and issues.
Then under Winslow, that's just an option.
That's an option.
We don't have to do that.
You do not have to do that.
But still bring them down.
Otherwise, it's an SA, separate
Separate
account.
account.
Is that similar to an SMA, separately managed
Same,
account?
yes. So, and I should say, with Allspring right now, you have a separate account. So you have a bank account at Salem Trust that holds securities, and then Allspring just does the buying and selling in that account. But it's your account at Salem Trust. So if you were to hire a Winslow, which is also a separate account, you're effectively just changing who's buying and selling in that account. Same structure. Alger is a mutual fund, and so that is more similar to how you have the JP Morgan and some of our other portfolios or other funds in the system, where you're actually, not to get into it, but you're Salem Trust is buying or selling into or out of the fund based on your direction.
But if we were an individual investor, a separate managed account would become with tax benefits and all sorts of
Correct.
neat things, but that doesn't affect us
Correct.
at all.
Yeah. Yeah, you're not gonna do any tax loss selling or anything like that for any sort of tax benefits. So,
But But if we ever wanted to exclude a certain type of company, it'd be much easier to do it in a separate account than it would be in
Yes.
a mutual fund.
Yes, absolutely.
Although I think we're prohibited from doing that now.
Yeah.
Yes, pecuniary factor rule, yes. That kind of gets you into a little bit of a legal gray area if you try to do something like that, but yes.
John, have you ever dealt with CIT?
They're really pretty new for me, but they exist more in the 401k world. I've seen them in 401ks a lot.
Ever heard of them? Something
They're
like-
hard for me to work out because they're difficult to look up. You need special tools and you can't just type in the ticker symbol like you can with a mutual fund.
They've been around a lot longer in the institutional space they've been around for 20 plus years. But what you tended to have is 20 years ago, if they had a mutual fund, you know, a fund company, they would offer separate accounts. But there's some inefficiencies there with having a lot of separate accounts. So you open a mutual fund to have, you know, a lot of investors in a single account that you can manage. But those would be, you know, 60, 70, 80 basis points. That'd be more expensive. And then a lot of institutions like, well, I'd like to be in a fund, but I'm not going to pay 80 basis points. So they started, in my estimation, they started collective vehicles because it gave them more flexibility in pricing. And they still had a contract, sort of the direct relational aspect of it,
Right.
but it was another account that could have multiple investors, but it was significantly cheaper than mutual funds. Over the last 20 years, the mutual fund prices have been coming down to the point where they're now a lot closer to, and in some cases, it could even be lower than CITs or separate accounts. But also, with advancements in CITs, they're doing other things where they can be held at custodians. You know, 20 years ago, they would not be held at your custodian. It was a separate kind of location. So, but again, just a few different options in there that could be explored. You know, if you're interested in moving forward with the Winslow, you have a couple of different ways you could get at it, and a few different things. So if you go to page number 2, a lot of numbers on here, but I'm really going to highlight just a couple of things. If you look at the very top line, the number of holdings, you'll see they range anywhere from 43 with Clearbridge, Winslow, 42 is the most concentrated, fewer than Allspring, and they range up to 81 with T. Rowe Price. Allspring's at 62, kind of right in the middle of that range. The other thing to note is the first line of the second section under characteristics, average market cap. So Allspring is 287 billion, is the smallest of the group. They tend to buy smaller names than the others, which range again anywhere from about 415 up to 815 billion dollars in average market cap. The index is about 600. I'm going to skip the next couple of pages, go to page number 4. Two different graphs here that show more or less the same information, but this is, to me, this is the proof statement that a manager is buying what they're supposed to be buying, okay? So it's large cap across the top, small cap across the bottom, and mids in between, and then values on the left, growth is on the right. So if we're looking at large cap growth managers, and I see a dot down on the bottom left, we're gonna have an issue, right? It means they're buying small cap value. That's obviously not what we're looking for. But what you'll notice is all of the plots are firmly up in that northeast quadrant. So they're all buying large cap, they're all buying growth. If you look at the left-hand side of that page, it kind of shows the average, if you will. And what you will notice, again, I mentioned Allspring is slightly smaller in terms of average market cap, and you can see that graphically. The blue dot is the lowest on the left-hand side. Okay? The other ones are all actually pretty tight to each other, being fairly consistent in terms of that kind of growth to value range, as well as the average market cap is a fairly tight dispersion. The next page looks at the performance in kind of the traditional format, the trailing year format. One thing you'll notice, if you go all the way out to the 10-year, each of these managers has underperformed for 10 years. I go back to what we talked about earlier with the concentration in FANG and the Mag 7 stocks being such a large component and such a large piece. You know, most managers have a maximum of say 6 or 7% of their portfolio in any one stock. So if the index has 11% in one stock and that stock does well, they're going to struggle. And so you really see that show up now in the 10-year. Now, these managers have not underperformed for each year for 10 years, but the performance in particular the last couple of years has pulled down that long-term average that you can see there. If you're curious about the individual years, you can see that on page number 6. We show the individual calendar years, and obviously there are plenty of years where many of these portfolios are significantly better than the index, and then obviously some periods where they are behind. Then the last thing that I wanted to draw your attention to is page number 10. Again, a lot of numbers here. I'm going to focus on the bottom half of page number 10, and really just a couple of lines. So the first one is the third line down, standard deviation. So that's the common measure of risk, and this is expressed as a percentage. So what you'll see is Allspring at 18%, Alger, Clearbridge, and Winslow are in the 17s, and T Rowe is right there at 18. So Alger, Clearbridge, and Winslow slightly lower volatility, but not significant. Beta, which is the next line down, is the measure of market risk. So Allspring is close to 1.01, and then obviously a varying range between the other managers, ranging from 102 down to 98 with Clearbridge. And then the last two numbers that I like to point out are the up-down capture ratios. I describe this as the offense and the defense. So when the up capture, when the market goes up, how much of that up move does that manager capture, right? So ideally, we want to up capture 500%, right? The market goes up 1, we want it to go up 5. But anything kind of near or above 100 certainly is positive. And then the down capture, how good is the defense? When the market's going down, as a percentage, how much of that down move are they going, right? So just as an example, Allspring on the 10-year is a 102.2 down. So if the market lost 10%, they went down, 10.2, a little bit more than the benchmark. So generally speaking, what you're looking for is a positive spread between up and down, which again, admittedly, in this kind of group of large cap growth has been very challenged, because most of these numbers don't really look all that compelling. I'll say that straight.
Don't look all that what?
Compelling. Most of the time when you see a surge in different asset classes, you'll have a 10-point spread, a 15-point spread between up and down, and ultimately that looks at a 10-year number that this manager is 1%, 1.5% ahead of the benchmark. But because of the challenges that we've talked about, these spreads are pretty narrow, the up versus down, and when you go back to that longer term performance, it's showing behind the benchmark. But one of the questions I often get is, if these managers can't outperform and you're paying fees, why not just go to an index? It goes back to the concentration conversation that I was having earlier. We're at unprecedented levels of concentration, in particular in the growth index. If we go back to anything that resembles normal or the average, the index is really going to have a hard time. Yeah, you're only going to pay 4 basis points or so to get it, but you're potentially looking at significant underperformance because you're so heavily weighted in such a small number of stocks. And to me, there's a lot of danger in that. But again, 2 years ago, I would have said the same thing, and here we are 2 years later, and it hasn't happened. It's only become more concentrated. But at some point, I think that has to change.
I'm gonna take you back to page 6.
Of course.
What is the rank? Explain the rank.
So that is a peer universe, so, ranking all of the large cap growth strategies that are reported within this Morningstar universe. So that's what it's representing, and it's a percentage between 1 and 100. So number 1 is the best, 100 is the worst. page 6, those are individual years, you see how the ranking was, and then on page 5 is sort of the collective ranking. So just as an example, I'll use Winslow because that's the better performing of the separate account managers. They're the 18th percentile. So even though they underperformed slightly over 10 years, they still outperformed 82% of the large cap growth funds within that space. And typically, we would expect the index to be somewhere around the 50th percentile over time. Last 10 years, it's in the 50. Again, sort of speaking to its very strong elevated performance, that concentration chart, if you just think about that, meeting the kind of the top of the heap, then the question becomes 10 years from now, what does it look like? Again, I tend to think it unwinds when it goes back to something closer to normal, but
So using that logic, we should pick the worst performer. That's the do.
First of all, we like all of the managers. So, I mean, but yeah, that certainly is as a method. One of the arguments is for a lower beta strategy. Again, if you had beta and concentration and then some of that larger cap, and then or conversely, a name was smaller. Now that's one of the things that actually would favor Allspring because they have been smaller, which has been a detractor. But again, our recommendation for moving on is not because of their size, it's because of the team element and the changes.
My red flags go up when I hear the discounts from Allspring, and I like the diversity that Winslow offers, and they seem to be performing pretty well over the course of time, so.
Does it,
Just in my,
on page 5,
Yep.
on the 3-year there, Winslow significantly outperformed the other investments. Is that, I mean, can you take from that during a downturn, they seem to perform better?
or at least they could stay par on a downturn and not.
If you look at page number 6, you can actually see that play out. So in 2022, they were down 30.6 versus the benchmark of 29. So they were down more than the benchmark, but they were down less than all of the others. So they did hold up better in that down market.
Right.
And then in 23, obviously the recovery year, they kind of held their own. They weren't the best, but they certainly weren't the worst. And then kind of the same story. There's been more variation here in 2024. It's only 6 months, but at 21 for the high end is at 29 for Alger, and the low end 30. But yeah, they certainly have done that. And again, I don't mean to make you flip all the time, but Winslow, longer term, their downside capture has been close to 100. So kind of historically speaking, they've been down essentially as much as the market, but in the last 3 years, they did a little bit better than their peers.
Well, I guess I'm kind of like John, I was waiting for the punchline in that, you don't like Allspring, and then you're giving it score, kind of mediocre, one of which looks better than the other 4.
When
So I
you-
assume there's something you guys like about these 4, that they've got potential?
Correct. Yeah, and again, if we had done this analysis 2 years ago, and then you look back 10 years, you'd see a much different performance profile in terms of outperforming. So again, just when we're taking this particular picture at this point in time, it's a little unusual from that. But we would expect each of these managers to outperform over time moving forward.
Did I miss the bit that John mentioned, we go for the worst of the lot?
That was just sort of the contrarian, the contrarian view.
There are, like in every field of life, there are incompetent players out there, so. But I assume, often you, just the scuttlebutt around the industry tell, like you mentioned with Allspring, they got some disruption going on, so they're looking at moving or suggesting that people move.
Yep.
But do you know something about these other 4 that even though they haven't exactly hit it out of the park, they've got potential, other than being down for over 10 years doesn't, or, I see Winslow as doing pretty well. And they,
Yes.
over 10 years, and I like a 10-year period because, market cycles last a few years and certainly, day to day, quarter by quarter, things change. And they seem to have, done reasonably well, even if they're not ranked, in the top 10 consistently.
Well, and what's, if you kind of remove yourself from the numbers and you think, if you were sitting at this table 10 years ago and you were looking to hire a manager, and I said, okay, we could hire one, and at the end of 10 years, you're gonna look back at your return and it's gonna be 16.2% annualized for 10 years. Would you be okay with that? I'd venture to guess you'd all say yes. The reason we're having kind of this conversation though is because the benchmark is 16.3 and you paid a lower fee to get that. It's only sort of in hindsight, but in absolute terms, the returns are there. The 16% is even above what we would expect them to do long term, right? You expect 11%, somewhere in that neighborhood for the large cap growth portfolio. So they've done very well in absolute terms. It's just that relative discussion because of what's happened within the index. But on a go-forward basis, again, I would expect a more normalized environment and one that these managers, generally speaking, will tend to do better relative to the peer group as well as the index.
Well, Winslow's already showed us they could do well in a downtrodden market.
Mhm.
So that's, to me, that holds tremendous value.
There's, I mean, again, we like all of them, but when you get back to, again, if you're willing to consider the CIT, that becomes the cheapest option.
Well, it's the cheapest, but it's diverse. We don't have to. We have that option on the
Correct.
table with them, where we may not have it with.
You said it's the cheapest. Are we negotiating with them?
No, it's just that the CIT is the lower fee, so at the 35, it's lower than the other fees that are requested.
You said it was 35 bips?
Correct. So I'm telling you, the separate account is at 60, and the CIT is quite a bit cheaper. Now, just to give you an example, like ClearBridge, separate account, you'd have the ability to negotiate that. I can't tell you what they would agree to, but they certainly, might be flexible. You have that ability. So, yeah.
Why not bring us more than, I get the 4, but even over if you do a 5-year look at it, we got 1 of the top 25 ranks. And the last year we got 1 out of the top 5. Why are we looking at, I don't want to say mediocre, but at the same time, why are we not bringing someone that's consistently in the top 6 or 7 every year? What is that based on?
There really haven't been, and the way you've been in the top 10, top 5, is to be incredibly, not just concentrated, but concentrated in the stocks that are the largest and have done the best most recently. And so from a portfolio construction and risk management standpoint, when our research team is looking at the long-term viability of a strategy, that's not one that really plays out as a consistent performer, because it's really hard to be that right about a very small number of stocks, consistently. And so the best performers have been, 12, 13, 14% of Microsoft, 13, 14% of some of these other companies. And that's from a risk control standpoint that, really think that that's a prudent sort of institutional type strategy. Nor one that we think will do, well for the next 5 or 10 years.
Yeah.
Because again, I
Is there
did.
a chance that those managers shift their strategy to?
So if we stay right where we are,
Mhm.
then we do not pay fees,
A fee holiday again through the end of the year.
calendar year.
Correct. And maybe that gets extended or something, but that's what they've offered up to this point.
Getting pretty close to the end of the calendar.
Yeah, it's really not that far away.
Yeah.
So again, I'd ask, first off, obviously, we're recommending you move on. We like all of these strategies, but, if you don't like any of them, we could come back to you with some other ideas. But if you liked any of these or had some interest in any of these, then the question becomes, how might you like to proceed? Would you like to interview any of them? Hear from them, hear a presentation otherwise? Or, in the past, the last time we made changes on the value side, you just made a selection and we kind of just moved on. We didn't hear presentations. But again, if you'd like to hear from some of these different managers, hear about their process, their style, and so on.
How many did you look at to come up with these 4?
I'm trying to think, in our research team sort of recommended strategies, I think there's I remember correctly. And it was, you know, trying to create a little bit of a cross-section, a few different, you know, styles, a little bit more defensive, a little bit more aggressive, in terms of bringing that offering. We certainly could look at some of the others if there was interested in seeing more.
Was it Thurbridge that you said would negotiate fees?
They can. So it's a separate account, meaning you're signing a contract that's specific to that portfolio. And so they have the ability to negotiate, or you have the ability to negotiate, depending how you look at it. As opposed to Alger, like that mutual fund, that is what it is. You can't change a mutual fund fee. But Clearbridge and Winslow on the separate account side, you can negotiate, but Winslow is probably going to negotiate less on a separate account when they've got the CIT that's cheaper. They said if you're looking for a better fee, go with the CIT, as opposed to negotiating on a separate account side. But that certainly is still an option.
So it may well be that the two options are Winslow or stay with Allspring. Do we want to just vote on that to, with more discussion someone wants to have, or do we want to?
Well, you would have to make the motion.
Right, I thought that you just, if somebody else has something else they'd like to say or questions.
I just want to throw out there that we don't have to wait 3 months. We can always have a special meeting anytime you guys want. So if you wanted them to come back with another, you know, more options a month from now, we could have.
Have you looked at the other options yourself?
Does any one of these jump out at you? Which one would be your choice? And why?
I mean, I'm leaning between them. I lean toward Winslow and Clearbridge for fees. You know, that's certainly that's the one thing that's guaranteed about investments. We don't know what the market's going to do, but you know what you're going to pay. You know what you're going to pay, right? So I lean that way. And then again, both of their risk profiles just at or slightly lower standard deviation, which along with a lower fee, makes sense. The only kind of caveat, if you will, is they're both a little bit more concentrated. But again, at 42, 43 holdings, they're not, unusually concentrated. There are some managers in the space that only have 23 or 24 positions.
Is that 440, that is saying that there are 440 large cap growth?
Correct. So of the Russell, the 1,000 companies that are in the Russell 1000, every June 30th, Russell decides how many and what percentage are going to be in the value and in the growth. And it changes every June 30th. I don't remember what it was prior, the first half of the year, but let's say it was 457, right? So it always adjusts a little bit. And what's really interesting is sometimes a company will be split between the growth and the value. It might be 20% in value and 80% in growth. So if you take the 1,000 growth and the 1,000 value and you add up those securities, you'll get more than 1,000. They're not completely split just between them. So it's sort of an interesting methodology.
If you want to give yourself a real headache, go and look how they classify them, and they figure out how the company is growth versus value.
Essentially price to book.
It goes way more than that, and it's a complete mess, and it's bordering on arbitrary at the boundary line.
Right.
It would be interesting to see, or to interview Winslow and Clearbridge, just to see who looks like they might have more flexibility fee-wise. Just throwing that out there. I think unequivocally we got to do from Allspring, my personal feelings, but.
I don't mind that, but I don't understand why we don't throw the index in the discussion as well.
A mutual fund?
Vanguard,
The Vanguard also 1,000 growth.
iShares, whatever.
Yeah, I mean, that is certainly an option. And I don't, in the report, I don't break it out because I include the index itself. That's essentially what you're going to get. The only difference is the fee associated. I'm pretty sure the Vanguard is 4 basis points for that. So that is certainly an option. I'll just say, given what's happened in the last 10 years in the concentration, and I have some plans that their growth assets are 100% passive. And my discussions over there's a risk that, some are talking about, but it's not getting a lot of discussion, how concentrated it has become. And really, the index is gonna come down to if Apple and NVIDIA and Microsoft do well, then the index will continue to do well. If those stocks don't, then it's gonna struggle, because it's so much of it is in that select small.
I get nervous with NVIDIA because of that pop that they had in the past year. That's just an anomaly, it's not normal. I think it'll level itself out.
Not based on their most recent earnings.
Sure,
No,
well, I
yeah.
mean, fair enough. It's not normal, that's for sure.
But yeah, an index is certainly an option. But again, it's one that I'm not suggesting for the reasons mentioned.
What percentage of our current equity is in passive?
We have a little bit more than, call it 20%. So we have the Vanguard total stock, which is, as of today, is at $18 million. All Spring was sitting at 17.6. JP Morgan right at 17 million, and then Eaton Vance, Atlanta was at 12.6 million. In the neighborhood of 25% or so. It is passive, but not on the growth side, it's on the core. Well, how would we like to proceed, or not at all?
How hard would it be to set up, meetings?
Would it not? They'd love to be here.
I'm sure people wouldn't wanna, I don't know if everyone would mind having a special meeting just to see them, so it doesn't happen sooner rather than later, but I'm all for it. Cause this is 15% of our portfolio, so, yeah, probably be careful who we actually give it to.
Rick, I think we should have at least Winslow and Clearbridge. I like the diversity that Winslow offers. I like the fact that they carried on through rough times, so. But
Just for clarification, Winslow was the one that offered the CIT, or was it
Winslow,
at 35 bips? Clearbridge, we'd have to negotiate if we can.
correct.
Okay.
I make a motion that we have another meeting to interview Clearbridge and Winslow.
Second.
Okay. A yea or nay for that? So why don't we do a yea or nay for that? So all in favor of that motion? Aye.
Aye.
Any opposed? Yeah.
The dates to be determined based on when you can get organized.
Yeah, I was gonna talk about this thing down there anyways.
And we'll leave it with All Spring until we can set that date and take that action. That is everything that I have for you today, unless there are any other questions. Thank you.
Okay, we have to approve the performance report. We have to do it by board, so how about firefighters, motion and second?
Motion.
Second.
Roll call.
George Kendler,
Yes.
John McDaniel, Lance Hewish,
Yes.
Debbie White.
Yes.
Police board, motion and second?
Motion. Second.
John Patrick,
Yes.
Matthew Wilkie,
Yes.
John Costello,
Yes.
Jason Stark.
Yes.
Okay, our board?
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman.
Yes.
Brendan Marisma,
Yes.
Eddie Vergara.
Yes.
All right, Justin?
Alright, administrative report, really not a lot changed, as far as the numbers go, I probably didn't have that much activity. Most of the activity was in the first 6 months of the fiscal year, so, just gonna go down more, we'll talk about the dates, but we have some continuing education coming up, FAPTA, conference is September
they'll make it happen. I'm not worried about that.
Can we do mid-October, like 6 weeks out, and then 6 weeks before the next meeting, that thing, or it's like split in half?
I can try that. I will have to check with city clerk and make sure the chambers are available. Whatever else, we could always have it at Parks and Rec also, if they're going, we always have it here, so we have a couple options. I'll shoot for mid-October.